Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. As investors struggle with the stock market and watch patiently as a bottom is searched for, they're concerned both about the heavy losses they've sustained in their own portfolios and about the prospects for recouping them. So in this part 2 of a 3-part roundtable series, our analysts are going to outline some strategies for making your losses back. Now, you know them by now, the participants, that is. Steve Reitmeister, our editor-at-large, Kevin Matris, our resident market technician, and Charles Roplet, our senior market analyst, all from Zacks.com. So, gentlemen, as we get into this part 2 over here, Steve, once again, I'm going to start with you.
Okay.
Strategies to earn it back.
Okay. One of the things we got together on Friday when we were going over the surveys from everybody and breaking up into the different topic categories we were going to talk about, and it kind of all struck us in the same way. You know, people wanted strategies to earn it all back. We're like, hold on. If people think they're going to earn this thing back overnight, they're just sadly mistaken. We don't want people to get too aggressive and make mistakes. Most people are down 30 to 50% right now. So if you're down 30%, you're going to need a 60% rise in your portfolio to get back to break even. And unfortunately, if you're down 50%, it's going to take a 100% rise in your portfolio. Obviously, that's not happening in the next couple weeks. Very lucky if it happens within the next 2 years. In general, for most people, it's going to be 3 to 5 years, even with strategies from Zacks, to make that money back, given the current environment and given the reality of what the stock market generally offers folks. Mm-hmm. We just want people to have that realistic outlook, because if they think they're going to make it back in a shorter period of time, they may employ overly aggressive tactics. You know, it's kind of like swinging for the fences and they miss, and they're going to dig themselves a bigger hole, which is what we don't want to see. So if people have a realistic outlook of at least 2 years, but more like 3 to 5 years, I think you're in a healthy framework in which to employ effective strategies. So with that in mind, the first place you got to start is the big picture of how are you going to do asset allocation of your portfolio. In other words, the breakdown of how much money in the stock market, how much money in bonds, cash, gold, etc.
Right.
And what happens with folks is our portfolios shift over time. And when the market's good, we move towards more aggressive portfolio mixes and a higher and higher allocation of stocks, which the closer you are to retirement, maybe not the best idea. So what we're trying to say is go with a clean sheet of paper approach. Let's put the losses aside. Let's put aside how your portfolio currently looks like, and how would you do it all over again today? And so with that clean sheet of paper approach, you're going to break down, you're going to fill up all the categories of how your money is going to go into the different buckets and the stocks and the bonds, and et cetera. And then what we're going to say is do it. Okay, the only thing that's preventing you right now from reshaping a portfolio is perhaps ego or fear or any of those kind of things. Go with that clean sheet of paper. Set up your portfolio to be as aggressive, of course, conservative as you want to be in that clear-headed, clean sheet of paper environment. And that's what you're going to do. Just a quick aside, I gave a very, the super quick version of this idea of redoing your portfolio. We had a video last week,
yes.
Extreme Portfolio Makeover. It's in the education section of our video player. So if you want a little more in-depth, it is there for you.
All right. I was going to say that, but I'm glad you did.
Okay.
So next then, we turn our attention to Kevin Matris, who is going to give us some of those stock portfolio strategies that we can employ.
Well, yeah, as Steve said, I think it's important to realize that you're not going to make it back in 1 day, in 1 week, in 3, 6 months, maybe even a year or two in some cases. It really depends on how beaten up you've actually been during this correction. But I think cool heads and people who can make smart moves, I think that they can be rewarded once we're able to come out of this bottoming phase and maybe even find themselves in a better position. I mean, if you take a look at some of the stocks that have been beaten down during this bear market, I mean, some of these things have just been sold off without any regard to their valuations or even just rationale. So the trick is to be able to figure out which ones of those stocks are the ones you want to get in. Again, I do not think that you should just be buying indiscriminately. I think that would be a big mistake. So I think it's important that diversification really takes center stage in your portfolio. And you want to make sure that you're in the right sectors and industries. Charles, he's going to be talking more about sectors and industries in just a moment. But once you've identified the right sectors and industries, now you have to figure out what kind of stocks within those groups you want to pick. The first thing I would say is when you're looking at an economic recovery, once you're looking at the stock market recovery, it should be noted that small cap stocks significantly outperform all of the other market caps. I should note that while this economic downturn is taking place, though, normally you see almost like a flight to safety, if you will, to the larger cap types of stocks. So instead of trying to figure out where you are in this cycle, are we in a contractionary period? Is it the beginning of a recovery period? I believe having exposure in all of these different areas with these different market caps is the right thing to do. But again, some of these stocks that have gotten beaten down so much, some of these stocks are going to roar back spectacularly. Other stocks aren't going to do that. So you need to start making some tough decisions. Which stocks am I going to get rid of? What kind of new stocks am I going to buy? I mean, I always think a 10% stop loss rule is a good thing to employ, but you should have thought about that 2 weeks ago, 6 months ago, or something like that. So here we are right now. I think that in order to try to find the best stocks, you need to focus on companies that have the best growth prospects and the best earnings estimate revisions, because these are the things that have proven to be the most predictive things as far as what stock prices are going to do. A perfect example is the recovery in 2003. The market rebounded by over 28%, but the Zacks number ones and the Zacks rank number twos gained over 74% and 71% respectively. And that's because the Zacks rank focuses on companies with upward EPS revisions, the best growth prospects.
Right.
And these are the companies you want to make sure that you're in. So again, if the very thing that kicked you into a stock in the first place no longer exists. Let's say you got in because it was a number one or a number two, and now they're a number 4 or a 5. You're going to probably want to get out of that stock. Don't get out of that stock and get tucked away in cash. Get out of that stock and put that money to better use in a number 1 or a number 2. Because there's also such a thing as an opportunity cost. Maybe the stock that you're in isn't going to, fall more, but if let's just say that your stock is just making some market gains at best, or let's say at worst, actually it does start trickle down lower, but you've got stocks in groups that are up 50, 60, 70%, wouldn't you rather have your money in those groups as opposed to the ones that are just kind of flatlining? So I would say those are important things to do. You want to look at companies with a Zacks rank of a 1 or a 2, because these are the stocks that are probably going to be responding the first, and these are the stocks that are probably going to be responding the best. Moreover, too, even if we do see the stock market really start to make a spectacular recovery, don't think it's going to go back to 14,000 overnight. You're going to see a nice bounce, but then ultimately you're going to see the bottoming phase ultimately start being put in, or my goodness, maybe we're going to go even lower. But I think if you start incrementally scaling back into the market, making smart choices, this is the way to be able to plan for your stock portfolio recovery. This is how you have to approach it.
Okay. Charles, kick on that rote radar for us, if you would, as you do in another segment every week, and give us some of the best and worst sectors that you're looking at as far as recovery and rebuilding and earning your money back is concerned.
I think one of the best sectors for people to be in, and really the industry groups people should be focusing on, is really the companies and industries where spending is going to continue, where even with the recession going on, we're still going to be spending into it. And there's several industries in various sectors, including when you look at defense spending, 2 wars going on, you look at medical. I think you got to look at both large cap pharma, where people need to continue buying their medicine, but also medical products. People are going to continue to seek medical treatment. Similarly, I think consumer staples tends to do well in the economy. People, obviously, when you look at the consumer products companies themselves, people that make things like Kleenex and toilet paper and trash bags, but I think you also have to look at the food companies. People are going to continue to eat. They're going to continue to want soup, produce, etc. So I think those sectors will hold up in the economy. I think someone who wants to be more aggressive and realizes that they're going to take a little bit chance on timing, however, you could take a look at oil service, because even at present levels, oil's still above the level that oil companies look at that they'd want to continue to invest in products, invest in projects. And we're really looking at oil staying above $65 to support spending on oil field services. But when we kind of look at those groups, the medical sector particularly stands out there because people are not going to cut back on their medical spending. You look at defense, we have 2 wars going on. So regardless of who's in office, we're going to continue to see spending on defense. Now, on the flip side, so far as sectors people should avoid, one of those is really the automakers. And I know as we record this on Monday, there's been a lot of talk about GM and Ford getting funding, but all the reasons why we're having this credit crunch, it's going to just make problems that much worse for the automakers. I think similarly, as from a timing standpoint, I think people have to be very cautious about the financial companies, particularly your banks, but also your insurance companies, because they do have exposure because of the tight credit markets and impacts their bond holdings, but also retailers. Retailers are very cautious right now, particularly the retailers who are not discounters. They're worried about Christmas spending. They're worried about holiday spending. The National Retail Federation expects this holiday season to be the worst and really since 2002. But I think as we get to the bottom of the economy and start seeing a recovery occur, we can also look at financials and consumer discretionary, particularly retailers, being among the best performing companies to play based on the recovery. Kevin did a study showing that consumer discretionary does extremely well coming out of the recovery. But I think when you look at the financials, still too early to get into it yet, but we're really looking at a situation maybe late 2009, maybe 2010. We don't know the exact timing, but it's really a scenario where we've set the bar so low in terms of current earnings that your year-over-year growth is going to be very strong. So I think it's a case where people need to let the bottom happen, but once the bottom happens, there are definitely 2 sectors that people should look at to continue playing, especially once the recovery kicks in.
All right, and there you have some strategies to employ to try to earn your money back in your stock portfolio as the global monetary officials try to rebuild the financial markets. Now, in Part 3, we're going to discuss wealth preservation. You definitely won't want to miss that segment. With the whole gang at the round table, I'm Terry Ruffalo.